What's the best way to manage stock portfolios? That's an interesting question, and we think we have the answer. My name is Ole Jakob Wold. I'm head of quant equity at Alfred Berg, and I'm here today with my partner, Narden Baker. We've been working together since 1994 managing equity portfolios. We're here to tell you about our products, how they're actually managed, what kind of research we've been doing, and to show you some excellent results from our portfolios.
To tell you our story about quant equity portfolios, we have to go back to the beginning. In the late 1980s, I was working on stock portfolio research with Professor Robert A. Haugen. Bob Haugen is a well-known academic, a finance professor, and an author of many investment articles and books. We were working on minimum variance portfolios, portfolios designed to have low risk. And we found something quite puzzling. These portfolios had low risk, but they didn't have low return. In fact, these portfolios were outperforming the market index year after year. We published the results of the low variance, low risk portfolios in the Journal of Portfolio Management. And then we decided to investigate why they were outperforming so consistently. As we began discussing these low risk portfolios with consultants and clients, we kept showing them that it was low risk and that they should invest in this kind of a strategy, and they kept coming back to the return. What we saw was an efficient portfolio. What they saw was gold, and they wanted to know where that gold was coming from. So we gathered some data on every stock in the United States from 1970 to the end of the 1980s. This data was fundamental data, book to price, sales to price, dividend yield, value characteristics, growth characteristics, as many characteristics as we could think of. And we built a massive database. All of these stocks had 60 factors, 60 characteristics each month. And we decided to use this data and try to figure out why these portfolios were outperforming and to see if we could actually create more outperformance. We learned some interesting things about these low volatility portfolios. They tended to have value characteristics. They were higher yield, lower PE, and better book to price. And it seemed that these value characteristics were related to the outperformance. To better understand what was going on, we decided to attempt an experiment. With all of these 60 factors, we decided to engineer a piece of research investigation where we would look at information existing at the beginning of January for a set of stocks, and then compare that information to the result of their performance through the month of January. So we looked at the 60 factors for every stock at the beginning of the month and analyzed it in comparison to their returns. Then we moved 1 month forward, and we did it again. And we kept measuring the impact of those 60 factors on the return for the next month. Using the data, we were able to analyze what the market was paying for in terms of these 60 factors through time, and we were able to make forecasts as to which stocks would outperform and which would underperform. We found something absolutely amazing, that the top decile, top 10% of the stocks in our forecast, outperformed the bottom decile by 35% a year on average. We were stunned. This model that we built, we called the fundamental factor model, because it was based on the fundamental characteristics of stocks and how those affected returns. Using this model, we found that a dynamic approach, one that moved through time, was the best way to forecast stocks. Our fundamental factor model was telling us something very interesting about the equity markets, that they were complex and also dynamic. Despite the complexity, we could make forecasts that would really separate those stocks that will do well from those stocks that will do poorly. We decided to write this up into an article to be published. Within a week, Bob Haugen had made his first draft, and we started to circulate that article. One of the professors to read that article was in Norway, and he tapped his brightest student to do some research and prove that our results were not right. Who was this student? This student was my colleague, Ole Jakob Wold.
I was studying finance at university, and one day my professor walked in with his article. He was clearly upset, and he slammed it to my desk and said, "Prove this wrong, that's your thesis." At that time, I'd been working for this professor for several years as a Fortran programmer, building a large fundamental database for Norway. So I had all the data, I could program this, and I took a close look at the article, did all the analysis, and I basically found the same results also for Norway. So what I did, I proved that it also worked. That didn't make my professor very happy, but I finished my thesis, and a couple of months later, I started working for an investment firm here in Oslo. This firm eventually became Alfred Berg. Nard and I started working together, and we started managing global equity portfolios using these models. In 1994, our clients showed demand for a core global equity product. And we designed a product with the technology that we've been describing that would be an all-season product with low risk. And this product soon came into all our clients' portfolios. We've been through value markets, growth markets, large cap and small cap markets, and bull and bear markets with great success. This product has delivered an information ratio of 0.5 since 1994. That was exactly what we set out to do.
So, how do we do it? How do we manage these quantitative equity portfolios? It's a complex world. There's so much information about so many stocks. There's so many things that drive these stocks. We have a way of taking that information, breaking it down, and making sense of it. To deal with the complexity of the stock market, we gather a lot of data on every stock across the world going back in time. The data can be grouped into 8 different classifications: growth factors, value factors, risk, momentum, sector exposures, size and stability, and profitability. Within each of these categories, we have further measures. A total of 60 different factors on every stock are collected. Using this information, we can now figure out how the market is adjusting its preferences through time. 60 factors? Why so many factors? Most organizations only use 10 or 15 characteristics when they try to understand and measure stocks. We use 60 because it's a complex world, and it changes through time. Our view is the market has preferences and is dynamic because those preferences change. This makes us unique. A famous economist, John Maynard Keynes, once reacted to a question by saying, "When the facts change, I change my mind. What do you do, sir?" This captures our view of the markets and the right way to manage money. To paraphrase Keynes, we might say, when the market changes, we change our stock opinions. What do other managers do?
You now know that we're dealing with large data sets. We're using 60 characteristics or factors for each company. And on the screen, you see a simple example of the regressions we're running on this data. In this regression, we're looking at market size on the first axis. That's the size of the company. So you have large companies on the right side of this graph, and you have smaller companies on the left side of this graph. On the second axis, the vertical axis, there is return for a month. So you can see there is a positive relation between market size and return for this month. This is a large cap market. However, we also have small cap markets, and those will be illustrated in this graph where the data set is sloping to the right. The bigger companies having low returns, smaller companies having bigger returns. This slope of the regression lines indicated in this graph, we call them payoffs. Those are the payoffs to this factor. This graphics is important. It shows the historical payoff to market size in the USA. If you look at 1999, that was a very strong large cap market. We owned a large cap portfolio at that time. If you look at 2003 and 2004, that was a small cap market. And we owned a small cap portfolio. This illustrates the dynamics of our process, the dynamics of the portfolios, and it's important. When we have done forecasts for all 60 factors in a market, we have a pricing model. We know something about what kind of preferences will be out there for the coming periods. That's important for a portfolio manager. Now we're ready to rank all the stocks. We made forecasts for all our factor payoffs, And stocks that have fundamentals that match these forecasts will have high ratings. Stocks that don't will have low ratings.
Now that we have a ranking for each and every stock, it's time to construct the portfolio. We use engineering in the construction process. By engineering the portfolios, we can control the consistency, both of risk and return. We achieve consistency by building portfolios that balance several goals at once: high return, risk control, diversification, and minimizing trading costs. For diversification, we spread the portfolio across all sectors and across many stocks. Usually we hold 100 to 200 stocks in a portfolio. By spreading out our investments and exposures, we can better control risk. High return and low risk are engineered into the optimization of our portfolios. Once optimized, we trade the portfolio in the stock markets around the world, and we trade efficiently, using electronic trading networks and paying extremely low commissions. By keeping our trading costs low, we can add to the return of the portfolios. Because our portfolios are engineered to outperform, we can set some expectations for our investors. Based on our experience, clients can expect us to outperform 80% of the time and have lower risk. 60% of the time, we have lower risk than the benchmark index. Higher return 80% of the time and lower risk 60% of the time makes for consistent and reliable performance. We have low tracking error relative to the index. With high return and low tracking error, we produce high information ratios, which are a good measure of consistency of our performance. Well, what a great ride it's been.
You're right. On this ride, we have seen growth and value markets, small cap, large cap, bull and bear markets, and we've achieved excellent results through them. We even achieved award-winning performance through the credit crisis.
Starting with our original research, and based on our experience managing portfolios since 1994 successfully, we can say that we've proven our case. Case closed.
If you want to know more about this or invest with us, contact your sales representative or call me directly. I'm at my desk working on this every day and I love talking about it.